the US market, and I'm talking about US large caps, are currently trading at the 97th percentile of all CAPE data going back to 1880. 97 isn't quite 100. I think it's hard to say everything points to bubble. I think that some things don't. Uh, but the predominance of the evidence suggests that this market isn't priced in a way that leads to really great outcomes for the next 10 years.
The stock market has seen a surge in animal spirits lately. The S&P has climbed over 1,000 points, roughly equivalent to a 25% increase in the past 4.5 months. Some bullish investors are celebrating this as a new era of easy gains. But is this enthusiasm justified, or are we witnessing another kind of irrational exuberance? Jonathan Treussard, a former partner at Research Affiliates and now founder of Treussard Capital Management, offers insights. Drawing from his research on financial bubbles at UCLA, Jonathan believes we are currently in the midst of another bubble. The S&P has surged approximately 25% since the October lows of 2020. In 2023, the Magnificent Seven stocks notably outperformed, posting an impressive 106% gain. Meanwhile, the Nasdaq saw a notable 54% rise. As you rightly noted, the S&P experienced a solid 24% increase, which was unexpected at the outset of 2023. Jonathan Treussard pointed out, "Look, do I think we're in the middle of a huge bubble? There are arguments for discounting that, but the reality is the valuations don't give you a lot of comfort should anything go badly." Treussard highlighted concerns about the market's valuation, suggesting possible risks despite differing opinions on whether a bubble exists. Dubravko Lakos-Bujas cautioned in a JP Morgan webinar that the recent 5-month stock surge could abruptly collapse without warning. After US megacaps, Nvidia is closing in on Apple to potentially become the world's second most valuable company. However, Chinese enterprises, initially reliant on US chipmaker Nvidia, are now exploring domestic alternatives due to perceived downgraded chip performance. Treussard highlighted concerns about Nvidia's market, stating that Nvidia and its investors fear a scenario where the global market divides, limiting their addressable market to only the Western world. Let's delve into the video to gain further insights.
The US market, and I'm talking about US large caps, are currently trading at the 97th percentile of all CAPE data going back to 1880. 97 isn't quite 100, and I think that's important to note. In fact, we were even more stretched before the decline of, the late 2022 period. But 97 is still about as high as it's been in over, nearly 150 years. There are arguments for discounting that, but the reality of it is the valuations really don't give you a lot of comfort should anything go badly. And again, I think that's the way to think about it, which is we've been just, as you're walking along the street and you're skipping over a bunch of cracks, and we've been skipping over, more than our fair share of cracks recently. But if we step on one, it could get ugly real fast. And I think that's the issue with the animal spirits part of it, which is, when the bulls run, it's great, but when they start, running towards you and for the exit, it gets pretty bloody pretty fast. Nvidia really needs to have a global market for this thing to make sense from a valuation standpoint. And whether or not these chips are finding their way into China today, which again, I repeat, I don't know, though I suspect it's happening. Nvidia is living in fear, and the investors in Nvidia have got to be living in fear of a world in which, the globe really breaks into two, and the addressable market isn't the world, it becomes the Western world. And I think every day that we don't get to that point is a day where, investors in Nvidia stock have got to be rewarded for the risk borne but not realized. That's number one. I think there's some political risk too. Right now, AI is in the infancy phase where, there isn't a lot of regulation, certainly not in the US, that's been put in place. And so this is kind of like best case scenario pricing where, most anything is on the menu. It's hard to imagine that we're going to be living in a no AI regulation world forever. And so I think there's some political risk that we don't know what that's going to look like. And then the last one is old school thinking about markets. As excited as we are about AI chips, I believe that NVIDIA has a huge amount of what I would call real economy beta. And what I mean by that is not their correlation to the stock market, but their correlation to the real economy. And if and when, because we know these things will happen, when the economy really slows down and takes a hit, and corporates are wondering how to make payroll or certainly where to cut, U.S. corporates will worry about those things before they worry about investing in AI applications. And the way I would say it is the U.S. consumer is going to worry a lot more about where their next meal is coming from and where shelter is coming from than use of AI. And so this is a really exciting thing that's happening, but under the best of circumstances. And when those circumstances change, the really exciting thing might be put on the back burner for a bit.
New data. Friday from the Bureau of Economic Analysis showed that even after adjusting for inflation, personal spending climbed 0.4% in February, comfortably exceeding the median estimate of economists surveyed by Bloomberg for a 0.1% increase. For all of 2023, the world's biggest U.S. economy grew 2.5%, up from 1.9% in 2022. In the current January to March quarter, the economy is believed to be growing at a slower but still decent 2.1% annual rate, according to a forecasting model issued by the Federal Reserve Bank of Atlanta. Treussard remarked that despite the surprising resilience of the U.S. economy, there have been hurdles, such as the bankruptcies of regional and Silicon Valley banks. Moreover, uncertainty persists regarding the Fed's tightening strategies, with speculation that these measures were halted in 2023 due to unforeseen circumstances. Now, let's redirect our attention to a video.
I think it's pretty clear that the global economy is really walking a fine line between a lot of data pointing to, a very resilient, particularly a very resilient U.S. economy, which, as we know, is critical to the global economy, and of course, a huge amount of risk and uncertainty on a variety of vectors, everything from geopolitics to the credit standing, particular sectors like commercial real estate. I think it's interesting to think about what we've been experiencing over the last 4 years, particularly since COVID started, as having played. I guess the way I would say it is, if you're tired, that's okay. It's been a minute. And as a result of that, I think a lot of people are trying to process information in real time while, running on fumes intellectually. And so it's causing just a lot of confusion. The other part of it, and this is something that I was talking to someone I respect very much in New York recently, is to recognize that the print is not sufficient to understand the way people are experiencing reality. One of the things that I was talking to this person about was the fact that if you look at the U.S. Consumer, the U.S. households, you say kind of everything is great. Unemployment is down, real wages are finally growing, so on and so forth. And you say, well, why are you walking around like the world is on fire? Why are you walking around with your head down? And I think the reality of it is risk. Risk, it has been realized for a lot of people over the last 4 years, and as a result of that, they're thinking about it on a prospective basis. A good way to think about not past inflation, but for example, prospective inflation, is the fact that I don't really care what my wages are today. I'm looking at my paycheck and I'm worried that I don't know what it's going to buy me in a year. And so, in a real way, no pun intended, inflation uncertainty is like a wage cut right now, even though it hasn't happened. So, look, the reality of it is the US economy is strong. And that has caused, I think, some of the runway we've seen in markets. It's stronger than we all anticipated, certainly about 15 months ago when we went into 2023 with near 100% probabilities of recession. And so in a lot of ways, we've dodged a lot of bullets. And by the way, some bullets we hadn't seen come along before they hit us. Things like the bankruptcies of regional banks and Silicon Valley Bank and so on and so forth. So that explains some of it. The other part of it um, is, and this is where it's hard to, and I think we've gotten some data on that particular front last week with the Fed. The reality of it is, I think operation whatever tightening at large, whether it's quantitative or real, was put on hold back in March of 2023 when those banks went under. And so it's just we've been kind of floating out there with the impression that we're tightening, but not really. And so I think that's been causing a lot of uncertainty in the market. We just the officials are telling us one thing, but the reality of it is, I think QE in particular was squarely put on hold back in March 2023.
Unfortunately, with inflation proving more stubborn, only some are convinced the central bank will follow through on rate reductions this year. The stock market is susceptible to interest rates due to highly leveraged, high-growth tech companies. Should rates fall, it would ease margin pressure, help earnings, and prove a win